I'm Taylor Riggs in San Francisco, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, Uber disappoints. The ride-hailing company posts third-quarter earnings that miss analyst estimates. We break down the numbers. Plus, a McFlurry of activity. McDonald's ousts its CEO over improper relationship. How does that affect the company's aggressive strategy of investing in tech? And it is 1 year until the presidential election, and states are now struggling to update election systems. What it means for voter privacy and election security. But first, to our top story. So Uber is out with earnings, and it is not a pretty picture for the stock. Shares are falling in after-hours trading on Monday after posting a third-quarter loss per share and gross bookings that missed analyst estimates. Also light of estimates, Uber Eats bookings and monthly active platform consumers. With reaction, I want to bring in Bloomberg Intelligence's Mandeep Singh and Tom White, an analyst with D.A. Davidson. D.A. Davidson makes the market in both Uber as well as Lyft. Mandeep, let me come to you first. Loop Ventures' Gene Munster seemed to put it correctly when he said he's a little bit surprised by the stock reaction, given he felt that there were more positives than negatives. Your take?
I agree. I think when you look at the top line number, the revenue number was really strong. And what the take rates tell you is that Uber is cutting down on subsidies, and that's showing in the improved take rates for both rides and Eats. So to me, ride growth and bookings growth and revenue growth all being in line is a sign that the company is curtailing subsidies and focusing more on profitable revenue growth.
And Tom, you can see that in the full year adjusted EBITDA loss now is narrowing from a $3.2 billion, now looking at only $2.8 billion. How much of that is an encouraging sign that they're able to raise those prices on the consumer?
Yeah, look, I think that the improved EBITDA loss outlook is nice. I'm not sure it's enough, given the way that investor expectations have shifted a bit with regards to kind of these high growth names. Investors are scrutinizing profitability a lot more, and I suspect that had Uber, provided more of sort of a step function change in the EBITDA outlook as opposed to sort of what really is more of a modest tweak. I mean, it's hard to call it $250 million improvement modest, but when you're on track to lose $2.8 to $2.9 billion for the year, I think maybe the stock would have reacted better if they were able to move that needle a bit more.
Yeah, Tom, talk to me a little bit more about that profitability, because we spoke last week when Lyft came out and said that they were going to be profitable by 2021, which was ahead of estimates. Now we're hearing from CEO Dara Khosrowshahi, and he's promising that on an adjusted EBITDA basis, they too will turn positive in 2021. Does that match up with where you want to see profitability?
Yeah, I mean, that's basically right around in the ballpark of kind of what we're forecasting. I think the challenge for Uber is that it's really a forecasting challenge in a lot of ways. Lyft, by contrast, operates in a North American market that now has two sort of pretty scaled players. Both are public and have to demonstrate, have the pressure of having to demonstrate a path to profitability for investors. That's not the case in a lot of the international markets where Uber's operating. Private companies, VC funded, and Uber really is playing the long game. So if one private competitor in a certain market really gets aggressive in one period with incentives, we think Uber's going to respond and react and accordingly. And that is probably good for the long-term health of Uber's business and their ability to accumulate market share. But it's going to make it tougher for them to forecast with precision kind of the timing of profitability, we think.
Mandeep, you smartly pointed out a miss here for Uber Eats. Your take on that?
Well, so Uber Eats is the growth part of the business, and they're still kind of fighting off that fragmented market where there are so many players trying to grab market share. So it's a sign that take rates have improved, but they haven't improved enough to the point that they can maintain that high bookings growth. So to me, the key for Uber at this point, given their profitability target, is to cut down on the sales and marketing expenses, because that's where Lyft has shown the maximum improvement. And I think they are trying to scale down their sales and marketing as well, albeit it's not happening as far as it happened with Lyft.
Tom, I want to show you a chart that I'm showing to our Bloomberg audience, which is in my terminal here, and it is the difference between Uber, which is trading at about a 48 handle on a price per share basis, and then the average analyst price target, which is about $31 a share or so. What is the difference that you're seeing between the price of the share and where the analysts expected? How much of that headwind has to do with AB5?
Look, I think AB5 is one piece of it. I think what's just sort of broadly happening here is what I touched on earlier, which is investors have really shifted their mindset to really scrutinizing profitability. And in Uber's case, they're making improvements on that track, but the sheer magnitude of the loss means that unless a quarter is sort of spot on perfect and really has no sort of weak spots at all, investors aren't really willing to give companies the benefit of the doubt. I think AB5 is a big issue. I mean, regulation for ride sharing and gig economy businesses broadly is something that I think is going to weigh on both Uber and Lyft and probably contribute to raising prices for consumers over the next few years, which could erode kind of the total addressable market for ride sharing until we get autonomous vehicles.
Mandeep, the CEO, Dara Khosrowshahi, he's kicking off the conference call, saying that he's really highlighting the scale and their ability to get superior economics and highlighting strength in Germany, Japan, Argentina. In your analysis, how much of Uber's strength really has been in these international markets, in these different business segment lines where they have differentiated themselves from Lyft?
Well, so obviously Uber is a global player and they carry that brand everywhere. So the big difference for me with Uber is they don't have to spend a lot on performance advertising like, Expedia and Booking.com have to do. They have the brand now and they are present everywhere. It's about improving the unit economics in international markets. We have seen that happen in the US market. That's why you see, 39% growth, which is very impressive. It's not translating in the international markets. Latin America was up just 2%. So that's where they need to improve the execution a little bit more.
And Tom, quickly here, bear with me as I show another chart to our Bloomberg audience, and it is all about that lockup, which we think is set to expire on Wednesday, November 6th. A lot of the free float shares outstanding, aren't trading. I believe it's only about 11%. How much in your analysis generally do you think this could be insiders trying to sell out maybe later this week and free up some of that cash?
Yeah, so we're certainly expecting some near-term pressure on the stock as a result of the lockup. Keep in mind that Uber was a private company for a very, very long time, and a lot of the early investors in the business, we think are effectively sellers at any price. So, we certainly expect a little bit of near-term pressure on the stock, but we suspect it'll be days, not weeks of impact.
Thank you to Tom White, an analyst at D.A. Davidson and Bloomberg Intelligence's Mandeep Singh. Now, another earnings news. Shares of Sprint closed lower on Monday as well as the company missed on both the top and the bottom line. Net operating revenue came in at about $7.8 billion, and that was lower than the $8.2 billion that was expected. The company says that it expects its T-Mobile deal to close in early 2020 and remains optimistic about the remaining regulatory steps as it continues to work with various state attorneys general. And coming up, a McFlurry of change at the top of McDonald's. We discuss how a new CEO may affect the fast food chain's recent push into technology. This is Bloomberg. A C-suite shakeup at the top of McDonald's has investors wondering how it will affect the company's strategy, which was poised to rely heavily on technology. From Uber Eats to kiosks in stores, the ousted CEO, Steve Easterbrook, had a distinct vision for the fast food giant, and he dedicated a good chunk of investment to innovation. Now, it will be up to Chris Kempczinski to keep tabs on modernization efforts at the chain's 38,000 restaurants. With more is Morningstar consumer equity strategist RJ Hodavi. He joins us from Chicago. RJ, given that we're a technology show really focused on those key innovations that McDonald's really had made, how much of the growth in the last few years and the outperformance of the stock really hinged on those investments in technology?
Yeah. I'd say it was a major driver of it. I wouldn't say it was completely dependent on technology, but it certainly was a major part of the company's growth the last couple of years. I think you have to factor in things like menu simplification and putting the refranchising, so putting company-owned stores in the hands of franchisees. But if you take a look at kind of the velocity drivers, the things that really sped up growth, it was things like the kiosks within the stores, delivery, mobile order. Those were very important. So I'd say it was probably the top contributor, but certainly played a part of a broader mosaic.
Well, and within your analysis, as you take a look at the average price of a check, how much has it gone up given that customers are willing to go online and pay for convenience, and that is what is perhaps driving that average price per check that's higher?
Yeah, that's certainly been a big part of it. If you look the last couple of years, comparable store sales have been in that mid-single-digit range, and largely about 4 points of that have been coming from the average ticket size. Now, about 2 points of that are just actual menu price increases year over year, but the other 2 points are really coming from what we call the mix benefits. So customers ordering more, and a lot of that's coming through delivery, where typically you see the average check size between 1.5 and 2.5 times the in-store order, and so it makes sense because you're usually dealing with large group orders, family orders, typically at the dinner time day part. That's usually what's driving that. And so I think that's been a big part of the story. As we continue to see delivery lap year over year, that might go down a little bit, but I think that's still going to be a bigger part of the story here, the average check size, and certainly tied back to the technology investments the company's made the last couple of years.
And RJ, as we take a look at mobile ordering, I mean, McDonald's had been making some clear gains. They were out to 14,000 U.S. restaurants, 22,000 stores globally at the end of 2018. How much more of a big push do you need to see to drive the stock higher?
Yeah, I think we need to see more and more of that, and I think that that's certainly part of the story going forward. What I think is going to be very interesting for the story going forward, I think that Chris Kempczewski had worked very closely with Steve Easterbrook in terms of the technology and mobile being a key part of that. I think the next steps for them, and I think Chris really needs to put a stamp of his own on his tenure, and I think that's going to come through tying mobile ordering to the drive-through. And the company's made a couple technology investments on that front. A company called Dynamic Yield, which is predictive ordering, a company called Apprente, which is more voice ordering. I think there's ability to tie that to the mobile device and mobile ordering. I think that's going to be a key part of the story going forward. And really one of the things that 2020, as it becomes more consumer-facing, more adopted, I think that could be one of the key stories to keep an eye out as we look to McDonald's next year, particularly when it comes to technology.
And how much of this is a shift that, Mr. Kempczewski can just continue to steer the ship of what his predecessor had set up, or how much more does he need to continue to invest?
I think that's the key question coming out of the announcement today. I think that he was effectively a co-author on a lot of the technology initiatives that the company's rolled out the last couple of years. He and Steve worked very closely on this front. But I think investors are really going to see the need to see the next evolution from Chris. I think we need to see that it's not just a continuation of the experience of the future and the mobile ordering and the delivery. There really needs to be his own stamp, and I think the opportunity really comes to the drive-through. That to me is the area where we haven't seen as much investment the last couple of years. McDonald's, with the acquisitions it's made this last year, really has the opportunity to redefine drive-through not only for itself but for the entire category with predictive ordering and voice ordering and even eventually AI involved with that as well. What happens when you do that? You unlock potentially new formats that you can do, smaller format, delivery only. Pickup only type locations, things that McDonald's really has never been in before. Really chance to even broader exposure for McDonald's and open up some avenues of growth. So I think that's going to be the important thing. I think people want to see that stamp, that new evolution from Chris.
And RJ, relative to McDonald's competitors, how do you like their partnerships with Uber Eats, with DoorDash, for example?
Yeah, I like it just because they are getting some of the best economics out of the deals compared to its peers. Just given its size globally and within the U.S., McDonald's is getting some of the best economics across the industry compared to its peers, from our understanding. So that I think is good. The company does talk about it. It does drive incrementality, meaning that it's bringing in customers that wouldn't be coming into the stores. Now, I think some of the numbers they talk about might be a little bit exaggerated, but I do think that it is worth its while. And I do think while it may not be as profitable digital as some of the an in-store transaction, it certainly is helping to bring in new customers. And I think over time, as you start to see, it's got to be paired with menu innovation. That's one of the areas where McDonald's has probably been a little bit behind this year. But as you start to see new products introduced, and customers who've already adopted delivery, I think it opens up an opportunity for this company going forward.
RJ Hodavy, Morningstar Consumer Equity Strategist, thank you for joining. And coming up, we hear from an NBA team owner and business executive about his views on company valuations and, of course, basketball. Part of our conversation with Golden State Warriors owner next. This is Bloomberg. Time now for the top tech calls. Bank of America has turned more positive on BlackBerry, raising the stock from a neutral now to a neutral from an underperform. The analyst says he sees limited downside in the stock following recent losses and cites a favorable valuation. He added that investors are overlooking key assets and a sum of parts valuation implies a floor of $5 for the stock. And Piper Jaffray initiated Cloudflare with an overweight and a $20 price target, citing positive trends for both cloud-related security and content delivery networks. The analyst said that while there are some concerns around the competitive dynamics, Cloudflare's platform is differentiated enough over the medium term. And Verizon Communications was downgraded to a neutral from a buy Nomura, with the analyst citing the risk that competition would weigh on the telecom company's growth rates. AT&T's new price reductions and T-Mobile's likely response reduced visibility into Verizon's near-term growth trajectory, the analyst said. And now Golden State Warriors owner and Kleiner Perkins partner Joe Lacob has many opinions on the VC industry as well as valuations. Earlier on Monday, he shared some of those thoughts with Bloomberg Businessweek's Jason Kelly and Carol Masser from the Stanford Graduate School of Business. Take a listen.
You know, it's very, very different. I was a guy that came out of a very different background. I was a science, biology major. I didn't really know anything about business, and I worked for a few years, and I decided I liked it. And I needed to get some business training. So unlike a lot of people who came from maybe Wall Street jobs, I didn't know anything. But I got in, I came here, it was one of the best schools then too. And it was a great experience. And for me, perhaps better than even some other people because I learned so much.
Well, and you learned a lot about Silicon Valley in a lot of ways, which is where you really made your career. What is it about that connection? I mean, obviously geography helps, but there's something deeper going on between this school, broadly the university, but also the business school and what's happening around us. What is it?
Well, I think geography does play a big role. I mean, for 40 years, 50 years, I mean, now we've been in what arguably is Silicon Valley. No one knows where Silicon Valley really is.
Right.
But this is in the middle of it somewhere. And the truth is, the classes are great. When you come to the Stanford Business School, you are with great students, all these other people that are in your class. But you're in this environment that is kind of hard to replicate. I told my kids, and I tell others, you can't really beat it because you're in the middle of something that is hard to explain. It's a culture. And I think that culture pervades the business school and the entire area.
What do you think about, we caught up with the dean, John Levin, earlier about what's going on here at the school. But it's interesting, I'm curious about, I feel like companies are dealing with a lot more in terms of ESG, leadership concerns. I think that it's very much front and center, accountability. Like, what do you think has to be a part of getting an MBA today? As someone who has been involved with many startups in the VC world, and we'll get into basketball in a moment, but what do you think has to be part of getting an MBA today? I
mean, it's just not about what's in the books, right? It's about a lot of other things, and there's so many issues that one has to be aware of to be a CEO, if that's your goal, or to be in business. And the world, it's a very international world now. You can't just think domestically, as we all know, and it affects the business I'm in even right now, as we all know recently. So I think you really have to have an experience where you get exposure to all of those issues. And I think that's what Stanford and this place does. It's very, very good at doing that.
Well, the dean talked to us about 40%, right. I think, of their students are
I thought it was
from
even
outside
higher.
the United States. It's pretty impressive.
So when you think about this place, Silicon Valley and Stanford, so many companies have been born of this. Private companies. We seem to also be at a moment where private valuations, public valuations, you've been in the business of venture capital for a long time. What do you make of this moment where people are trying to decide what something is worth, and there's candidly some disagreement out there? How does this end?
Well, I'm not really investing as a venture capitalist so much. Maybe privately as an individual to some extent. But
you watch the market. You have
I do.
to watch.
I do. I'm very aware of it all.
Yeah.
And I would say
Hyper-aware, one might
hyper-aware.
say.
You can't help but be.
Right.
But I would say that clearly private valuations are very, very high, and there's some structural issues going on here with respect to the giant funds that have been raised and the prices they've been willing to pay for some of these startups or a little bit later stage than startups.
Yeah.
And so I think that the public markets, private markets have to sort of figure all this out. This is no different, though, that's gone on in the past to some extent. We've had these periods where private company valuations perhaps have gotten what some people believe to be too high. Public companies' valuations have to sort of make do with all that. I think it'll all work itself out.
So, Joe, the idea of like IPOing, is it still going to make sense in the future?
I hope so, and I think so, because that's something called liquidity.
Yeah.
When you're in a private company, you don't really have that liquidity, and that's the big difference. And I think liquidity is a very important thing in investing. It's not just about return.
Right. But even with all that money, that's whether it's in private equity or family wealth offices, there's so much money in the private markets right now. You don't think that that's going to kind of put a damper increasingly on the IPO market?
I mean, it has to some extent, you could argue, in the years leading up to this period when you've got all these companies now that are considered the select group that are trying to go public or have gone public recently, and they've stayed private for a lot longer than they would have because they had access to capital. But at some point, not all of them, but many of them really want to have the liquidity or they just need to be public companies for the exposure.
Right.
All right, I've resisted for as long as I possibly can. We got to talk about basketball.
I'd rather talk about that anyway.
Yeah, exactly. Because I have to think, you walk through this campus and there are people who look at you and see, well, that's what I want to be when I grow up, is I want to own a basketball team. It's not easy right now. What do you make of the season so far? Because there have been some twists and turns.
Every year is the same way in the NBA. It's unbelievable how you start the year and everyone has a certain mindset or expectations and they change. Because the fact is that players get better, some get worse, some get older, the younger ones are emerging and injuries happen. And so the truth is that every year is the same thing. You don't really know. And that's what makes it great. And this year in the NBA anyway, unfortunately for us, to some extent, we have a lot of injuries, but it's really exciting, I think, for the fans to know that, truthfully, there's 9 or 10 teams that any one of them might win the title. That's exciting. Now, I'd rather be the prohibitive favorite like we've been in previous years.
I'd rather not have the injuries.
Of course, I'd rather, but it's sports and things happen and you have to adjust.
That was Joe Lacob, owner of the Golden State Warriors and partner at Kleiner Perkins. And coming up, it is Attack of the Trolls. Protesters in Hong Kong aren't just fending off police, they're fighting against re-emerging social media trolls. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. And now we join Bloomberg Daybreak Australia to bring you the latest in global tech news. Joining us is Sherry An in New York and Heidi Stroud-Watts in Sydney. Let's take a look at those top global tech stories of the day. Heidi?
Taylor, TikTok executives have declined to testify at a U.S. congressional hearing. Representatives from the music-sharing app were requested to appear before Congress on Tuesday. TikTok saying that it's unable to provide a witness on short notice. That's according to the Washington Post. TikTok, which is owned by China's ByteDance, is being investigated for national security concerns. China is reviewing locations where Presidents Trump and Xi would be able to sign the first phase of a trade deal. The signing was originally supposed to take place at a now cancelled Asia-Pacific Economic Cooperation Summit in Chile. No decision has been made on whether or not Xi's visit will be part of an official state visit to the US. And Taiwan Semiconductor Manufacturing will continue to supply Huawei with chips. This comes with Taiwan's government denying a report that Washington asked it to lean on the semiconductor giant to suspend business with its number 2 customer. TSMC is the largest producer of made-to-order chips for most of the world's biggest tech corporations, from the likes of Apple to Qualcomm. And those are the top global tech stories that we're watching today. Sherry.
Heidi, thank you. Just months after Twitter and Facebook said they had removed hundreds of accounts used to undermine Hong Kong's protest movement, the social media trolls are back. Research firm AstroScreen has found that of 30,000 accounts tweeting about those protests, nearly 10,000 were created since August. Joining us now to discuss is Isaac Stone-Fish, Senior Fellow at the Asia Society. Isaac, great to have you back. So what is this telling you about the reach of the Chinese government, perhaps, when it comes to these social media attacks?
The Chinese Communist Party feels like any story that involves China should be a story that it gets to direct. So what we're seeing is something that's been pretty common on the Chinese internet and the Chinese language internet for a really long time, which is that the story of Hong Kong has become a global story, and Beijing is recruiting an army of trolls, putting together an army of trolls in a way that we don't fully understand, to try to shape the narrative and get people to think closer to the way that the party thinks.
How successful has it been so far?
I think for the trolls, it hasn't been that successful. The party's often a lot more successful when people who aren't as clearly linked with the party replicate its views. I think we saw that with the NBA scandal, when you had top basketball stars saying things that sounded pretty similar to how the party refers to the situation in Hong Kong. Oh, this is something we shouldn't talk about. This is a China issue. We should just play basketball. Let's not politicize this. That's a much more effective strategy for them than having a Twitter account with 5 followers say something about the protests.
And Isaac, I mean, just frankly, this seems to be an uphill battle. I mean, the companies like Facebook and Twitter, they're trying to do their best to clean up these platforms, but frankly, they're going up against the Chinese government. What else are they supposed to be doing to help protect and clean up their platforms?
It's a really tough struggle for both of those companies, especially Facebook, because even though Facebook is blocked in China, I think its second largest ad market is Chinese companies and the Chinese mainland. So they make billions of dollars a year from the relationship with Beijing and with Chinese companies. So on the one hand, they want to push and allow these to be platforms for free speech. On the other hand, Facebook especially doesn't want to push too hard because it doesn't want to alienate Chinese companies, and it still does have this great dream of someday bringing Facebook to 1.4 billion Chinese people.
What is a role that the U.S. government can play? Because now we're hearing that potentially the U.S. government could launch a CFIUS national security investigation into, say, TikTok that's owned by China.
I think what the U.S. government is trying to figure out is where to draw the line between, oh, this is a Chinese company, it's investing in an American product, or it has this really good app that's popular globally. This is great. We encourage innovation. We're glad that they're doing this, to, oh, actually, in the case of TikTok, which has been downloaded, I think, 120 million times in the U.S., they can collect a lot of really useful data about American habits. Is that a line too far? It's something that I think the U.S. government and a lot of analysts in this space are still trying to figure out. What is appropriate behavior and what is not? What is a national security concern and what is not?
But then you have this pressure coming from the U.S. government, coming from the Congress, coming from the administration. What's the likelihood that there will be some backfiring, with Beijing actually trying to reach those tech ambitions even faster than their Made in China 2025 vision?
I think the backfire is going to come a lot stronger on companies like Huawei, which, although it's nominally a private company, has very deep ties to the Chinese party state, whereas TikTok really is a private company and doesn't have the same national security implications that a company like Huawei does.
Isaac, as you talk about TikTok and some of the CFIUS review news that we got on Friday, do you just assume further CFIUS review of these foreign ownerships and these foreign investments given heightened tensions?
I do. I think that's a very safe bet. And I think because the situation with Russia is so radioactive among so many in the Republican Party because there's no way to talk about Russia without implicitly criticizing Trump. A lot of people on the Republican Party, like Senator Marco Rubio, want to be strong on national security, recognize that in a lot of ways Beijing does pose a very real threat to national security, and think, oh, this is a way that I can be tough on this and not have to wade into the deep mess that Russia is in the U.S. Congress.
Isaac, do you think it's isolated just to the tech sector?
I don't. I think this is something that we're going to be seeing across all sectors. And we saw it in Hollywood. We saw it in sports recently with the NBA, which is something that I think many of us watching this space never expected to see. So really no sector is safe from this kind of politicization. But I also don't think that's a problem. These are intensely political issues, and companies in this space really need to have an understanding of the politics behind the issue.
In the meantime, we see China just continuing to move forward with their tech strategy. We saw the rollout of 5G, for example. We also saw that President Xi Jinping wants to develop the blockchain sector, so blockchain-related stocks just rallying last week. Why has tech dominance become so important in this U.S.-China battle?
I think it's a really good litmus test for who's winning. Is China going to be the country that dominates next generation AI? Are they going to be the ones who really win in 5G? I think both countries like to see this somewhat akin to a Sputnik moment. Okay, who's doing best on R&D? Which country's model is superior? And I think the big difference, hopefully, is that the U.S. is just having this little blip with the Trump administration. We'll move back to some of our core values, both economically and ethically, whereas Beijing, unfortunately, does not seem to be moving away from the tech-dominated authoritarianism that they're diving deeper and deeper into under Chairman Xi Jinping.
It was so interesting to see Mark Zuckerberg in Congress talk about the need for Libra just because China is coming up with their own virtual currency. How far along are they in these tech sectors?
I think it really depends on the sector. And I think one of the issues that we have here is that the U.S. tech sector is so much more open, both to foreign investment and also just much easier to understand. We have a lot more transparency here. We have a much better press here. And we don't have the same information about the Chinese tech sector. We don't really know what, say, any AI that involves the Communist Party's military, the People's Liberation Army, has. We just don't know. There's a lot more black boxes there.
Thank you to Isaac Stone-Fish of the Asia Society and Sherry Ann and Heidi Stroud-Watts of Bloomberg. And we will have much more ahead. This is Bloomberg. Sunday marked 1 year until the 2020 U.S. presidential elections, and while the top Democratic challengers jockey for a position to be the one to take on President Trump, plenty of questions about the state of election security still remain, from the safeguarding of electronic voting machines to social media companies with ads that feature fake news. We'll be focusing on all of these issues this week in our electioneering series. This Monday, we look at how states are struggling to update their election systems before 2020. Now, according to a report from the Brennan Center for Justice at NYU, states will have to spend more than $2 billion to protect their election systems in the next 5 years. For more, we have Professor Lawrence Norden of New York. He is the Director of Election Reform Program at the Brennan Center. And in studio with me, it's Bloomberg cybersecurity reporter Karthikey Mitra. Karthikey, let me just start with you. Outline for us the state of the states, if you will.
Yeah, so since 2016, states at least have learned that there are hackers trying to gain access to their voter registration networks, voting machines. They have an idea that there's something they should be looking for. Malicious actors are out there. What they're having trouble with is necessarily gaining the resources necessary to gut their systems and build the protections necessary to ensure that 2016-like hacks don't happen again in 2019 or 2020, and to know exactly what to look for that hasn't happened in the past. That's probably the biggest challenge.
Larry, in your opinion, and through all of your amazing work that you've done and the research that you've done, what is the most vulnerable section for you when it comes to not only the election on Tuesday when we go local, but really going into 2020?
Well, that's a difficult question to ask. I would say the big thing, because so much of our elections is run on computers. For me, the big thing is making sure that if there is a successful attack against voting machines or the voter registration databases or the electronic poll books that we use, that we have resiliency plans in place so that even if a system goes down or there's a problem with the systems, people can still vote. And we make sure that at the end of the day, those votes will get counted. So really what that means is making sure that states and counties have enough resources to have backup paper ballots, to have paper backup poll books if they're using electronic poll books, which most states do at this time, and they have the right procedures and training in place so that even if something happens, and I think we have to assume the worst case scenario when you have nation state actors that are potentially attacking small county election offices, that we're prepared and people can still vote with confidence.
Kartikay, are states getting enough help from the feds?
The states will say absolutely not. They're doing the best that they can with the resources they've received. So in 2018, Congress approved another $300 million that will be distributed to states and counties across the United States. $300 million across thousands of voting jurisdictions isn't that much. So no, probably not.
And Larry, I mean, what really struck me in your report is of the $2 billion needed in the next 5 years, 40% of that needs to go with cybersecurity. Is that how the election hacking and election meddling is happening? Is it that cybersecurity weak point?
Well, look, there's no question that our move to computerize our elections, which has a lot of benefits, makes it a lot easier to vote, make sure that errors are caught, also comes with an additional risk. And I think when we made that transition, and that really happened in 2002 after the mess with the hanging chads in Florida in the 2000 election, Congress passed this big package to computerize everything from the machines to the voter registration databases. There wasn't enough planning about what that meant, that meant that there had to be a consistent long-term investment. Just like we do in an office where we have IT staff and they're constantly updating and upgrading, or your iPhone, it's the same thing with our election systems, and we really haven't invested in them that way.
So, Kartikay, look, Tuesday are these local elections. Do you just assume there's nothing we can do? Have we done anything since 2016?
I think states have done quite a bit since 2016. The biggest change has been this push to get rid of the devices that you touch and result in a vote, right? You can still touch a screen and that'll be tabulated, but now there's, in most places, a paper trail where you can verify that the button you pressed is churning out the result that you're looking for. Also, tomorrow is going to be a big test for those jurisdictions with new systems. These will be the first time that a lot of these paper trails are going to be tested in jurisdictions that really lack IT support. So they'll really have to figure out whether their auditing systems are up to the snuff in case there are malicious actors in their networks. Tomorrow's a big day.
Larry, as we move on from Tuesday to 2020, what is your biggest risk?
Well, again, look, I think one of the big things here, and Kartikay mentioned this, we've got 8,000 separate election jurisdictions in the United States. Many of them have no IT support or cybersecurity staff. So getting those jurisdictions more resources so that they're prepared on election day is really critical. That means having extra cybersecurity staff, IT staff, and as I said earlier, having backup plans in place. Because, there are problems in every election. No election is perfect. So having backup plans in place, whether it's because of malicious action or just because there are errors in the system, so that people can vote and those votes get counted, are really critical.
Larry, I have to ask your thoughts on Facebook not fact-checking political ads.
We could spend a long time talking about the issue about fact-checking ads. That's a difficult issue and conversation, and a long conversation to have. I think one critical thing on this, I think, is that Mark Zuckerberg, when he says We just want everybody to see if a candidate is lying, and so we're going to put it up there. I do think that's a little bit disingenuous. One of the problems in 2016 was that we didn't know about a lot of these ads. There's something called micro-targeting, so that ads can only go to a select number of people. So I do think that leaving the issue of fact-checking ads, passing requirements for more transparency in these ads so that everybody can see them. There's something called the Honest Ads Act, which is a bipartisan bill that Senators Klobuchar, Graham, and Warner have sponsored, is really critical. And we had FEC Chair Weintraub, Ellen Weintraub, had an op-ed in the Washington Post, I think just yesterday, calling for the end of micro-targeting for these ads, so that you could reach a particular geographic area just the way we do with television ads, but then everybody sees it, as opposed to having these ads that a lot of people just don't even know about.
Well, like you said, this is a much longer discussion to be had. That was Professor Larry Norden of the Brennan Center for Justice and Bloomberg's Kartikeya Mehrotra. Thank you both for joining. And still ahead, Facebook has a new effort to improve people's perception of the company. That's next. This is Bloomberg. The U.S. has filed paperwork to formally exit the Paris Climate Accord. The State Department made the announcement on Monday. The notice starts at 1-year clock for a full U.S. withdrawal. In the Paris Agreement, nearly 200 countries set their own national targets for reducing or controlling pollution of heat-trapping gases. An outcry over cloud deals with big oil is getting louder within Google's ranks. More than 1,000 employees inside the tech giant are calling on management to ditch deals with companies like Schlumberger, Chevron, Total, and Saudi Arabia's Aramco. With details of a letter published Monday, I get to bring in Bloomberg Technology's Mark Bergen. What do we know about what the employees are saying?
Yeah, so this is a letter that came out this morning. Is addressed to the CFO, Ruth Porat. It's pretty wide, but the main salient points here is it's asking for the company to put together a climate change plan that includes dropping contracts with these oil companies, committing to not working with the border agencies. The activists here are connecting some of the work the immigration authorities have done with climate refugees, and also to stop donating to politicians through the political action committee that they see as either climate denying or sort of against the science of climate change.
How has Google responded?
So far, Google hasn't put out a formal response. They sent us a link to the blog post from Ruth Porat in September. The company has, you said repeatedly, Google has clearly been a leader on renewable energy purchasing. They were one of the biggest first companies to come out and say we're going to commit to 100% renewable for their data centers. In September, they made, I think, was the largest ever purchase from a corporation. So Google's response thus far has been, look at all this leadership we have in procurement around renewable energy, but they haven't responded directly to sort of the cloud contracts they have with some of these oil and gas companies, which is the issue here. And
how tense is that relationship right now between a business that wants these cloud deals and then having their employees weekly, monthly basis really protest all of this? How do you draw the line between the business line and making your employees happy? What is that tension like at this moment?
Yeah, it's been fascinating. It will be fascinating one at Google. I mean, this issue has actually come up at Amazon and Microsoft, two bigger cloud companies. The difference here at Google is successfully a year and a half ago, the employees were able to nix a contract that Google had with the Pentagon. And so Google employees have shown success in being able to actually stop some of the work. I think, my sense is that the companies, the Pentagon defense industry, the energy industry, these controversial sectors are big markets for Google's cloud business, and so I don't see them relenting that easily.
Thank you. That was Bloomberg's Mark Bergen. Thanks for joining. Now we also stay with big tech and take a look at Facebook. They own Instagram and WhatsApp and wants everyone to know it. The company started as a single app, and now 15 years later, Facebook is adding new corporate branding to distinguish itself from the social network with the same name. Joining me to discuss it is Bloomberg Technology's Kurt Wagner. Kurt, why the branding change?
Well, you kind of mentioned it. Facebook here owns a bunch of different services, including Instagram, WhatsApp, and of course Facebook, the social network. And historically, it just kind of uses the Facebook name to encompass all of those, but it's not always clear to users what you're talking about when you're talking about Facebook. Are you talking about Facebook Inc., or are you talking about this social network? And so the company is trying to, use branding, at least as part of the way of clearing up some of that, and of course also using that new brand then to kind of lay claim on some of its other products like a WhatsApp or Instagram.
Kurt, it struck me when the chief marketing officer told you in your story that it improves the perception of Facebook as a company when everyone knows all of their brands. Is that true?
That's according to their research, and that's part of the reason that they are doing this, is that they say that when people find out that these products that they do like an Instagram or a WhatsApp, is owned by Facebook Inc., they feel better about Facebook Inc., right? This is a company that created something that they actually like. And so by that measure, it would make sense why the company is now putting that branding inside of Instagram and WhatsApp, because, Facebook is not does not really have a super strong reputation at the moment. So if they can kind of steal some of that from their other properties, I think that's what they want to do.
Doesn't this just highlight more antitrust concerns when they are literally telling every regulator all the companies that they own?
That's one way to think of it, and I think that there has been some people who have argued that this whole notion of bringing all of Facebook's products closer together is one way for them to be harder to split up, right? If everything says it's made by Facebook and there's a technical underlining there, it's just harder for Facebook to split that stuff out. At the other side of the coin there, they just announced this big deal with the FTC around privacy, and part of the issue is that Facebook has not been clear about what data it collects. So this could also be kind of seen as them responding and saying, well, here, we're going to make very clear what data we collect because we're going to put our name on everything we own.
Very smart. Bloomberg's Kurt Wagner, thanks for joining. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.